To that interest rate cut as we came on air. As our titles were rolling, it was announced that the Bank of England has cut interest rates to another record low. They were down to 1%. Remember, not long ago, they were over 5%. They were 1%. They are now cut by what the city calls 50 basis points, taking interest rates to a new historic low in the history of these islands of 0.5%. John McFall, does it make any difference?
I think it does, actually, and I think it signals, Andrew, that the issue in the economy now is not inflation but deflation. And if we have falling asset prices, what it means is that people will put off their purchases, there'll be less demand in the economy, there will be more unemployment, and we really have to do something now to tackle that.
We will come on to the quantitative easing business, of boosting the money supply in a minute. Let's stay with interest rates for the moment. Why is it in this economic crisis that interest rates have had to go to 0.5% when they didn't even go that low in the misery of the deflationary depression of the 1930s?
I actually think it's related to the global nature of it, Andrew. And I think if you look at the velocity of change, it's enormous. Look at America, for example. Last year, I think there were 2.5 million people unemployed. In November and December, 700,000 in each month. So it's that velocity. And the learned economists, the Nobel Prize winners like Paul Krugman and others, are saying it's adapting to that velocity change that's the hardest of all. If there was a longer time scale, then we'd be able to adapt to it much better. And that's the change. It's the key.
You're a businessman. Does interest rates at 0.5% make a difference to you?
The irony of this all is that we are in this position today. One of the main reasons is because we had the longest period of real low interest rates in history for over a decade. And that was one of the fundamental causes of the credit crunch and the situation we're in. And here we are, we're back to low interest rates, lower than we've ever known them. And these interest rates should have been dropped well before last summer. And last summer, we were worried about inflation. And I was one of the people saying, please drop the interest rates. Not because as a business I want low interest rates. Do it. You can dampen the effects of the upcoming recession.
Does it make any difference to you?
And of course they waited till October. Absolutely not.
None?
And it's not being passed on as well. Up to 80% of the interest rates cast last time were not passed on. And of course, what about savers as well?
They're passed on the mortgage, though, aren't they? You can see mortgage rates have come down. I was speaking to some friends who've got mortgages. They looked at how little the rate was. They looked at their mortgage payment and wondered if a mistake had been made.
But not all of them. Again, the vast majority have not been passed on. And of course, lots of people are locked in as well. But at least the government are trying. At least they are trying and reacting.
We have a lot to talk about on this. Joe.
We do, and we want to hear what you've got to say about it. So if you want to send us your comments about any of today's stories, do get emailing to daily.politics@bbc.co.uk, and we'll read some of your thoughts out, of course, later on in the show.
Right, let's see if we can tell you a little story. Imagine if you were broke, stony broke, at home, feeling sorry for yourself. Actually, if you're watching this show, you probably are. You got no money in the bank, no money under the mattress. As a last resort, you look in your sock. That's empty too. What would you do? You've already tried a bailout, or two, or three, and then by chance you look in the shed in the bottom of the garden and you find a printing press. And you think, hello, I'll print myself some money. You getting this story? I digress, but only a little bit. Here's Giles with his guide to quantitative easing. It's not a laxative. It's because with interest rates so low, the Bank of England is running out of ways to kickstart the economy. So today they decided to go ahead and magic up tens and billions of pounds out of thin air.
Put simply, quantitative easing is a tool for fixing a blockage in an economy that isn't running smoothly. But how does it work? Well, first, it relies on the government allowing the one mechanic who's able to utilise this tool, a central bank, to do a little bit of conjuring. Now, in our case, that bank is the Bank of England, and it effectively takes this tool of monetary policy and simply increases its bank balance, just like that, by an amount the Chancellor will set. It's like creating money out of thin air or filling up a petrol tank with imaginary petrol. Then the theory is that you take that money and feed it back into the system in very specific ways so that eventually you ease things up and you start fixing the ailing engines of the economy. So what are these specialist ways? Well, there's three specific ones. They can buy government bonds. These are the government's IOUs to people who've lent them money to be paid back over a specified amount of time with interest. Or they can just loan to other banks. Or they can buy other banks' assets for currency. Or most likely of all, a very specialist mix of all three. Now, the aim is to reduce the interest payback on government bonds, reduce the overnight interbank lending rate, and increase the amount of deposits in private banks. The effect should be to increase the supply of money in the system and thereby get lending going again between the banks. That is what most economists agree is needed to get any recovery started.
Giles still not there. Well, we're joined now by Danny Gabai, a former economist at the Bank of England and founder of the Monetary Policy Forum, which independently scrutinises the work of the bank's Monetary Policy Committee. Thank you very much for joining us today. We talk about printing money. Is money actually printed?
Well, no. It's created electronically, as most money is now, but the government effectively now has created, from what I've seen now, £75 billion on account at the Bank of England.
Will it work? I mean, is there any guarantee that it is going to be a success? Because people will say, well, you know, look what happened in Japan. People saved the money and it didn't actually kickstart the economy.
I think we have to be honest. We don't know. As you said, we've had one example of quantitative easing in practice and it didn't work very well. There are a number of us, a number of economists over time have specified a number of mistakes they feel that the Japanese authorities made along that route, and hopefully we've learned from that. But no, there's no guarantee that it'll work, and I have, and we at the Policy Forum at Fathom have some concerns about the way that this process is being carried out now. Effectively, we still need an efficient and working banking system for this to make any sense. The Bank of England is going to deposit,
yes,
in return for government bonds, it's going to deposit cash in these very damaged institutions.
Yeah.
The hope is that these damaged institutions will then get that money out to the economy.
Now, what about the problem then of inflation? It may not be a concern now, but when do you turn the tap off?
Well, you know, inflation would be quite a nice problem to have, because it would mean that we've actually got through this very difficult period. What the immediate concern right now is debt deflation, where prices are falling so quickly that people don't want to buy anything because you might as well wait till tomorrow. There will be inflationary consequences of this, and in fact that's what they're trying to do. They're trying to prevent deflation by raising prices across the board, particularly for certain assets.
Danny Gabai, thank you very much for joining us.
John McFall, these are extraordinary measures, for extraordinary times. What we don't know, and Joe was touching on there, is that the government, or the Bank of England, puts all this cash into the coffers of banks and companies too. We'll buy bonds back from companies as well. But it can't force the banks to then use this money. What happens if it doesn't?
That's a good point, Andrew. Danny mentioned the issue of quantitative easing taking place before, and the example is Japan. But what Japan didn't do, and I visited it in October and spoke to the policymakers, is they did not recapitalise their banks quickly. They did not recapitalise them sufficiently. And we need to have banks that are recapitalised. So that asset protection scheme, the insurance scheme that the government came out with, that's really, really important to underline the bad assets in banks so that we get the confidence back to the banks. And if that is sufficient, then the banks will lend, because if it's recapitalised, they've got this extra money to lend. And the issue of corporate bonds is important as well, because here's a Bank of England going out directly to the private sector and taking their bonds and giving that money directly to the big corporations.
But the markets clearly don't think the banks are fully recapitalised, otherwise their shares still wouldn't be in the dirt. So to the extent that they aren't recapitalised, the banks, I mean, if I was a banker and I've got problems on my balance sheet at the moment, I may take this money and be glad to have this cash on the balance sheet now. I'll just leave it there because that'll help my balance sheet. I'm not going to lend it.
Well, that is a danger. and I've no doubt about that. But what the government have been doing with the banks is ensuring that they have these lending agreements. For example, last week the Royal Bank of Scotland, that they got this lending agreement, and I've been saying to the government, with HBOS Lloyds, they really should get this agreement going, so that you've got that agreement, what the private sector, what the banks will give out to the private sector, and also have that monitoring element in it. So it's really, really important. And the more transparency there is in this process, Andrew, then the more confidence the markets can have.
Now, we're getting to the end of the line here, though. I mean, we have, I'll bring Karen in a moment, but we've cut interest rates to 0.5%, a historic low for 400 years since interest rates became public. We have guaranteed interbank lending. We have taken huge stakes in our two major banks, and we've got all sorts of asset liquidity schemes. Now we're essentially pumping money into the system. If this doesn't work, we have nowhere to go.
Well, monetary policy isn't working, and therefore this is the route to ensure that that monetary policy works, so that we do deal with the deflationary element, and as Danny said, get inflation back to a certain extent. That's it. And when we get to that
When
stage...
did we ever think we'd be saying that?
Well, exactly. But this is a trick, Andrew, you know, with the Governor. When he sees this demand increasing, then drawing that liquidity back from the market is important.
Now, you're worried, other people are worried that this can lead to inflation, that we're pumping money in, and the most extreme example of that, of course, is the $1 trillion notes in Mr. Mugabe's Zimbabwe. But at the moment, I put it to you, the bigger danger is not inflation, it is that this won't work and we'll head for deflation.
If you go back to just over a year ago when Northern Rock was nationalised, the amount we were talking about then of £25 billion to rescue one entity, one bank, and we thought that's bigger than anything in history. Now that's pocket money compared with hundreds of billions in different forms, as you've said, that are there to try and ease the financial system.
But the government's not just handing this money out. This is being swapped for assets. The government's taking back its own debt in the form of gilts, which is a bankable asset, and it's taking corporate bonds for a bit more risky, but it's taking them as well.
Yes, it is providing support of hundreds of billions.
Right.
And all to try and unfreeze what we have now is this reverberation between the real economy and the financial sector. And lending has frozen. As a business, we find it very difficult to borrow. And I've heard this, businesses of all scales, multi-billion-pound businesses are finding it difficult to borrow.
Why do you find it difficult to borrow now? You as a profitable business?
Because the banks are just not willing to lend. They're in such a difficult state because they've got lots of loans to repay. They've taken support from the government, they've got to repay. They're also worried about lending because of a recessionary environment. They're worried about the debts being repaid.
John McFall,
so they're caught in a
catch
catch-22 situation.
Well, yesterday in the Financial Times there was an article by Martin Wolf about America saying to nationalise or not to nationalise. That's the line that we've got to go down if this isn't working. And I think it's a warning to the banks. I want a profitable and I want a lively private banking sector. So we must ensure we get these lending agreements. We must ensure that transparency and monitoring and get that out. And I've heard the same comments from people. Big issue still to get the lending. Let's go. Get that message out loud and clear. And I use the Daily Politics programme, Andrew, to make that point.
Then it